Welcome to the MFA fourth quarter market update. Lots and lots going on in the market. Thankfully, we're in a much better place than we were earlier in the year. A lot of concern about where the market was headed. We've seen some rebounds. Greg Dukes, Executive Vice President, MFA Wealth. What's going on? Bring us up to speed.
Very good things have happened over these last 5 months, Chris. As you mentioned so accurately, the S&P 500 is now up 11.4% year to date. It was down around 7% earlier.
In April.
So
that's an 19% swing in the index since April, showing the importance for people to stay invested. It's hard. That discipline, we always talk about that. We're coaches here at MFA Wealth. We're saying we have to help people stay in the market, stay invested, certainly stay diversified. And at some point we have to be practical, we have to be prudent, we have to be stewards of our money. But in this situation, had they not stayed invested, it would have been really an enormous miss and an opportunity.
Exactly right. It was a very quick rebound, and a very profitable rebound, as we've been able to review with a lot of our clients. The impact of not only the tech sector, but also the energy sector and some of the different plays that we see happening throughout the different sectors that we were very apt in identifying early and reacting quickly as the market rebounded, moving out of April into May.
On Thursday, I was with Charles Payne. We were talking on his show, Making Money. We said there was two big things going on. Morgan Stanley came out with a big announcement saying that people are underestimating the tidal wave of jobs, of opportunity that's going to come from AI.
Correct.
And I think we're on that boat. We think it's still, people are undervaluing that a little bit. But secondly, totally separate and totally the opposite side of the track, the International Monetary Fund said there's going to be a tsunami of job losses, which is true. But I think that maybe it's going to be more measured, right? It's going to be slower. And I think also that the job losses, people adapt and get new jobs. We were talking just the other day to one of our friends at one of the largest, distribution companies, delivery companies in the world. And they said, we're using so many robots, you can't believe it, but humans have to be involved. So I think we're going to adapt those jobs. I think certainly we cannot wait. The Industrial Revolution took about 70 years, the Industrial Revolution, and it certainly displaced many, many people. Most of those people found new roles, new jobs, and I think that's the way our economy works. It's very efficient. That's what we're banking on.
Yeah, you're exactly right. Your key word there that you mentioned is adapt. Yes. That's what's going to be, is there's going to be a shift from workers from one place to another, perhaps within the same company, perhaps within the same sector. Those are what we are starting to identify, and it's an interesting segue into one of the sectors that's down currently, basically flat year to date, is the energy sector. Yes. Energy has become extremely attached to technology. Yes. How are we going to impact and power these AI data centers?
We don't have enough energy, right?
That's
we just don't.
Right. How are we going
to
power all of this? It's exactly
natural
right.
gas.
We see this as a big opportunity, using your analogies, to not only see the breadth of the workforce adapting, but also the different sectors that are now attached to technology, that are attached to real estate.
So coming to the end of the year, we're still seeing energy as an opportunity. We're still seeing AI as an opportunity. We're seeing the broad markets as an opportunity.
Very much so. We expect 2 more rate cuts from the Fed. We're watching basically a 3-legged stool, one being inflation, secondly being unemployment, as you so accurately described, and the third thing being corporate earnings and forward-looking outlook.
And earnings have been great. Is that an overstatement?
So that's a great segue into this particular slide. Earnings have been great. Earnings continue to be great and are forecasted to continue.
And that's the big thing. Forward-looking earnings is something we look at quite a bit here. We don't say earnings are great, but we're looking at forward, and there hasn't been as much downward revisions as normal, correct?
That's exactly right. And what we continue to see here is people are worried about the markets being at all-time highs. Well, what we're seeing and identifying is a lot of these companies are continuing to set new highs and live within those expectations.
Certainly when we manage money at MFA Wealth, we use stops as a kind of a backstop for a hedge against dramatic downturns in the market. But as we come into the fourth quarter, we're optimistic.
Very optimistic. And I think that as we start to see things normalize in the economic cycle, the yield curve is starting to normalize. We start to see the inflation numbers all at 3.1 and below. And
say that again. There's nothing, and all the inflation markers we use, indicators, the highest one is at 3.1%.
3.1, and that's core CPI. That's
so when the Fed was saying 2%, and everybody thought it was crazy, they're in that range.
They're in that range. That's absolutely correct.
So we're saying the Fed did its job to manage interest rates down.
The Fed did a great job of managing it down from 9% down to 3%. The goal being 2 is still a very apt and achievable goal, but there are things that we are concerned about as it relates to getting to that goal.
So for our clients, certainly we're here when they have questions. They can call us anytime. That's what we're here. But as we think about looking into the fourth quarter, we're saying broad diversification, consistent with your risk level, which is very, very important. We're optimistic about the markets. If we have some unforeseeable thing, which happens every day, President Trump, maybe a smidge alarmist, right?
Correct.
That happens, if that's the right word. We have stops in place.
Correct.
We like energy.
Very much so.
We think healthcare is actually underinvested, dramatically underinvested. I think when the some of the folks really got pharma scared, and we think it's underinvested. We think if you look at the demographics, if you look at what's happening with folks, healthcare we think is a place that creates great opportunity over the next 6 months for sure.
100%, and financials as well. Rate cuts only help financials.
The banks are going to start making
Correct.
money, and then M&A is going to pick up too because it's less expensive for money. So I think all that together, as we cook it, we see a relatively robust fourth quarter. We see it bleeding into the first quarter of next year. But I think in general, we feel that our portfolios have done well. I think the market's done well. We think that investors that have stayed invested have done well.
That's exactly right.
So with that in mind, I think that's a good update for the fourth quarter. Please contact us so we can answer any questions. Thanks so much.
Thank you.